Hello there. Welcome to this episode. In the previous episode, I shared with you my journey, my Forex trading journey from rags to riches. I spoke about my story of how I became a Forex trader. I mentioned the milestones along the way, the obstacles, the challenges. What I didn't share with you is how I actually did it. What do I do as a trader now that I wasn't doing 13 years ago? How am I able to make money from trading when so many people are not making money? Which skills have I learned along the way? Which habits have I developed? Those were all practical elements of trading were not covered. Hence why you have this episode. This is going to be very educational. So please take notes, unless you're driving. Then take mental notes and then listen to the podcast again and write the notes down. I do believe the previous episode was very educational. Hopefully it was inspirational. And I hope this episode is the same. So let's jump right in. How did I do it? How did I become a Forex trader? I've given this much thought and I've created a list of 10 things that I do which I believe losing traders do not do. It could be that losing traders do some of these things but not all 10, because if you did all 10 I think you would be making money as a trader. So what are the 10 things? Let's just jump right in and get started with number 1. And number 1 is forecasting market direction. Most losing traders will look at a chart, so Euro US dollar, and say, well, the moving averages are bullish, so I'm going to buy. Or there's been some price swings lower, prices downtrending, I'm going to sell. Forecasting direction is 50% of the trade. 50%, I would say. If you can forecast the direction right, you're so much more likely to have a profitable trade. It's the foundation of every trade that you take. Too many traders do not give enough thought to market direction, to predicting, to forecasting market direction. So what do I do to forecast market direction? I use a combination of fundamental analysis and technical analysis. Fundamentals drive the markets. That's what gives a market its direction. It's fundamentals that impact supply and demand. In the Forex markets, that's things like interest rates. I spend a lot of time forecasting interest rates because if I can get that right, I can generally get price direction right. Interest rates drive currencies. To forecast interest rates, I track and forecast inflation, because inflation figures have a major influence on future interest rates. So do other economic figures, retail sales, unemployment rates, GDP, those sort of things. I have lots of content on my website, my YouTube channel, all about fundamental analysis. This episode of the podcast isn't about fundamental analysis, so I don't want to spend too much time on this. But what I'm trying to say, the point I'm trying to get across, is to decide if Euro US dollar is going to be bullish, bearish, or move sideways. It's not as easy as just looking at a chart for a few seconds and making that split decision. I put a lot of time into fundamental analysis, into creating a bias for the pair, and then go from there. I then combine that with technical analysis and make sure both are in agreement. So my fundamental analysis and technical analysis both agree. Great, now's the time to start looking for trading opportunities. I've built that foundation. I have that foundation. Let's take a trade. So direction is number one on my list. Think more heavily about market direction. Forecast market direction. It could be that you do use technical analysis, purely technical analysis, that's fine. But use support and resistance. Look at lots of charts and the correlation between currency pairs. Try and use higher time frames and just make it more detailed. Put a lot more effort into forecasting direction. Take your time. So that's point number one. Point number two, and I will kind of echo myself, repeat myself now. Point number two is fundamental analysis. So I use fundamental analysis. It makes a huge difference. Not just for market direction, but use fundamental analysis for risk purposes, for getting out of a trade. If fundamentals change, then market direction is likely to change, so you can get out of a profitable position or get out of a losing position. Using fundamental analysis can create additional trading opportunities. I cannot emphasize this enough. Fundamental analysis is a great tool, and it's one of the things that I do that I attribute to making me a profitable trader. And once again, I have lots of content on my website and YouTube channel all about fundamental analysis. Let me grab a drink. I don't know if you can hear it, but in my voice, I am struggling a bit. Okay. Point number three. MTA. Multiple time frame analysis. The third thing that I do that I think has made me a profitable trader is multiple time frame analysis. Lots of losing traders want to be 15-minute chart traders, so they trade the 15-minute chart and analyze the 15-minute chart by itself, nothing else. From my experience, the more time frames you use, the better. So I trade the 1 hour time frame. All my trades are executed on the 1 hour, and I manage my trades on the 1 hour. My take profit is also based most of the time from the 1 hour time frame. But my analysis before taking the trade, putting fundamental analysis to one side, is analyzing the weekly, the daily, and the 4 hourly charts. So weekly, daily, 4 hourly, 1 hourly. Use multiple time frame analysis. The more time frames you look at, the more information you have, the more support and resistance you have. It's well worth using. Point number 4, support and resistance. It works. It is everywhere. It's a great tool for entering trades and for exiting trades. I use horizontal support and resistance, especially daily and weekly horizontal support and resistance. The same with diagonal support and resistance. It's always based on the weekly and the daily. Sometimes I use 1 hour support and resistance too, but those daily and weekly levels are real key. Pay attention to them, and they're great for stop losses, stop loss areas, and take profit areas. I also use support and resistance from moving averages, dynamic support and resistance. It works very well. It gives you additional trading opportunities, but once again, it helps you to identify potential exit areas. If things are going wrong or going right, it's a good place to get off. The market could reverse at those areas. Number 5, trading journals. Keep a trading journal and be as detailed as possible. You need to record the date of the trade, the date you entered, the date that you closed the trade, you got out of the position, the reasons why you entered the trade, the currency pair you're trading, the time of day you entered, the time of day you closed the trade. If you use multiple time frame analysis, if there was any fundamental analysis, what the market conditions were like at the time, the result of the trade, and any other information you can think of, detail it and record it. It's so useful for developing a trading strategy, but also reviewing your performance. If you ever start making changes to your trading strategies, then you have this detailed record of previous trades that will help you with those modifications. Keep a trading journal. Apart from detailing each trade, let me grab another drink. As mentioned, I'm really struggling today. Apart from detailing the information of the trade, also detail how you're feeling, how you felt before taking the trade, how you felt after taking the trade. Make it like a diary, your trading diary, as well as your journal of the trades that you're taking. Point 6, stick to your trading plan. Now this one is huge. So many people are stuck in this cycle of having a trading strategy, trading it for a while, hitting a drawdown, giving up, finding a new strategy, trading it for a while, hitting a drawdown, giving up. This is the loser's cycle. I actually call it the loser's spiral, because emotionally, as they go round and round, their emotions go down and down and down. It's this spiral. It can be a financial spiral too, and financially they're worse off each time they go around the cycle. If you have a trading strategy, and you need one, if you have a trading strategy, stick with it, at least for 6 months. Don't trade something for a week or a month or a couple of months and then give up. If it made money through your backtesting, if it's a strategy that makes sense, that should give you an edge, then stick with it, at least for 6 months. And combine that with your trading journal and everything else that I've mentioned so far, and you should be on your way to become a winner. So stick with the trading strategy. People give up too easily, and I'll come to that in a moment, but they don't stick with it. They do not give a trading plan, a trading system, a trading strategy enough time. They're expecting too much too quickly, and when that expectation is not met, then they give up. Point 7. Expect drawdowns and embrace them. So this is a good follow-up point from my previous one about sticking to your plan. What I do is I expect drawdowns. I expect regular drawdowns. I expect to be in a drawdown most of the time. Your expectations will determine your emotional state, how you react when you have a losing trade or a winning trade. So many losing traders don't actually expect to have a drawdown. In theory, they may have accepted that, but when they face it in reality, it's a whole other ball game. It's a whole other story. expect to have 3 losing trades in a row, maybe 4, 5, 6, 7. Expect to have drawdowns every month, because this is the reality of trading. You will have frequent losing trades. Even if you have a 60% win rate, there's no reason why you couldn't have 8 losing trades in a row. You need to embrace that and accept that and expect that as the reality of trading. If people don't expect that, then they get stuck in that spiral, that cycle that I just mentioned. So just to reiterate to this point, I put a lot of emphasis into forecasting direction. I use fundamental analysis as well as technical analysis. I use multiple time frame analysis. Don't just get stuck on one time frame, but use a variety of time frames. Use support and resistance. Keep a detailed trading journal. Stick to your trading plan no matter what, and expect drawdowns and embrace them. My next point is more of a mental personality sort of skill than it is a technical skill, and that is to be determined, to have a strong commitment, and to face the market with clear determination that you're going to make this work. There have been ample opportunities over the last 13 years to give up, to not become a trader because I've hit another drawdown, or the strategy hasn't worked after 6 months, or life has got crazy and the kids are too demanding, or I'm not making enough money, or whatever it is. Be determined. You need to decide now that I'm going to make it as a trader, and that you're just going to keep pressing forward. If you're not determined, you're not going to make it. And this is not a life skill that is purely for trading. This is a life skill for anything worth achieving in life. If you're going to set up a business, you have to be really determined if it's going to be a success. If you want a successful marriage, you need to be very committed and very determined that you're going to make it a success. That determination is real key. Number 9, position sizing. I risk anywhere from 0.1% to 0.5% per trade. I used to risk up to 1% per trade, but as time's gone on, I've actually brought that risk down to 0.5%. So I don't risk anything more than 0.5% per trade. You need to do that. That is basic risk management. If you risk too much, you're going to be too emotional, and you're going to blow your trading account. If we were to draw a graph, a chart of the correlation between risk and emotion, then you'll see that the more you risk, the more emotional you are. The less you risk, the less emotional you are. So have position sizing that is strict and consistent. If you're going to risk 0.5% per trade, always risk 0.5% per trade. Don't change it. If you're risking 0.5% or 0.25% per trade, it's incredibly difficult to blow your trading account, which is what lots of new losing traders do. The reason they've blown their trading account is they're risking too much. How can you blow a trading account if you're risking 0.25% per trade? It's not going to happen, or at least it's not going to happen quickly. So position sizing is something else that I do. Be consistent and keep position sizing to a minimal. And then the 10th thing is risk-reward ratios. Always ensure that your return is much greater that the potential return is much greater than the potential risk. And lots of people know this. They know what risk-reward ratio is. If I'm risking 0.5%, I need to make 2% back. The return, the expected return, has been much larger than the potential risk, the possible risk. The reason why I bring that up is some people don't do that. They don't let winners run long enough to bank that decent risk reward. Another reason why I mention it is some people think 1 to 2 is healthy risk reward, but it's not. So my winners are big. 1 to 8, 1 to 9, 1 to 10 risk reward. And I don't want to go for the impression that I'm banking one of them every week or every day or anything like that, because that's not the case. But when I have a trade open that's doing well, I aim for about 1 to 10 risk reward. That's where I want price to get, because the winners have to be big. The bigger, the better. So ensure that rewards are big. So they are the 10 things that I do that have made me a profitable Forex trader. Now, each one of those points is a whole podcast episode within itself, and I have lots of content on my website about each of these things individually. I have a post that I recently put up. It's a whole page dedicated to risk management. Go ahead and find that. It will teach you so much about risk management. You know, a big part of trading is managing and reducing, and if possible, eliminating risk. I have gone through this list quite quickly, but please believe me, each of these points are so crucial. And as mentioned already, I could spend a whole podcast episode talking about one of these points, and I have in the past with some of these points. So just because I've gone over these things quickly, please do not think that they're not important. You could spend weeks studying and creating plans and put into place things just to cover one of these points. Okay, that brings us to the end of the episode. Thank you so much for listening, for being with me today, and I'll speak to you in another episode of the Forex podcast.